Have you ever been scrolling on the MLS trying to find a multifamily deal and you see assumable mortgage? Well, in today's video, we're going to discuss how you can actually assume those mortgages, so stay tuned. Hey guys, Josh and Aaron back for another Finance Friday, and in today's episode we're going to talk about CMHC assumptions. Have you ever gone on the MLS or looked at a listed property and it said, something along the lines of assumable mortgage, and then you were like, oh, well, let me take a look at that, and how does that work? Well, today's episode we're actually going to discuss how you can assume those mortgages and why it might be advantageous to you to actually do so.
Yeah, so obviously there's a few different benefits going into CMHC and assuming the loan. If any of you saw what rates were with CMHC 2-3 years ago, you were looking at 1.5%, 2.5%, depending on the loan size. And some of those might even be valid for 10 years. So obviously if you're able to pick up a property with a super cheap, high amortization type loan, that's going to be amazing for your cash for the next 10 years. You're going to be able to get yourself a great deal. And, obviously that can be very attractive. The biggest issue when we're taking a look at assumptions and anything with CMHC is obviously the timelines and what that means for how long is that seller going to have to give you to close. Your average CMHC timeline, start to finish, can be anywhere from like 4, 5, maybe even 6 months, depending on the year, like where in the year you are, if you're around holidays, how complex the deal is, how large the loan size is. And sometimes, even though the seller is selling the building and they're forcing you to assume that loan, they don't have that much time to close. So that starts to beg the question, what types of options are available?
So really, there is two types of assumptions. The first one is just the basic assumption as you would normally have with a regular mortgage. What this does is it allows you to be able to take on their mortgage. But to do this, obviously, you still have to meet the qualifications that a normal mortgage would have. So if CMHC required the net worth requirement and the experience requirement and the liquidity requirement, then you're going to need to have those requirements to be able to actually qualify for the loan. So this usually takes the same amount of time as you would normally have when submitting a regular CMHC loan. So if in instances when the seller has extreme flexibility and you have the time to be able to start the process, resubmit the loan, and go through the entire application process, this does work. Now, some of the challenges with this obviously are the lender who currently has the mortgage. You actually have to go back to the same lender who's facilitated the mortgage in the first place to be able to assume that loan. You can't just go to a different lender and try to assume a loan that was facilitated by a different lender. So keep that in mind. Your broker is going to have to take you to the original lender that facilitated that loan. Second is that you're going to have to think about is the difference between the actual assumable loan and the purchase price. So you're obviously purchasing it for more than what they had refinanced it for when they initially had restructured the debt. So you're going to have to cover the difference between the current assumable loan and the purchase price of that loan. That's going to be your equity position in that property. Sometimes, depending on when you're assuming the loan or how much you're assuming the loan for, they could be selling for quite a bit of a profit. So keep in mind that you're going to have to inject that capital to be able to assume their current first mortgage. Now, if you wanted to top up, there is instances when you can do a pari passu loan at the same time and increase that if the net operating income does allow for it. Just keep in mind that the process is significant and does take a standard time to process.
Yeah, and other things too, like second mortgages or VTBs are able to be put behind as long as the lender's okay with it. And your overall loan to value and debt servicing is in line with the lender. You can sometimes add on these secondary types of financing just to help boost up that equity position. The second way you can do the assumption is a little bit less known, and it involves some negotiation with the current seller. So in certain situations where, maybe it's the end of the year and the seller's trying to avoid capital gains, or maybe they're in a power of sale situation, they have a certain amount of time to get rid of this building, whatever it is, maybe they don't have 4 or 5 months to close. Maybe they need to close in like 2 months. You can do CMHC assumptions on transactions where you can close within 30 days. This involves the current seller keeping their original guarantee with CMHC. They're still going to come off title, and the transfer of ownership is going to be there. The equity payout is going to be there. You can add the VTB in behind, or the secondary mortgage, or the CMHC pari passu. Well, in this case, I guess you're not going to have time for the pari passu. So the VTB and a secondary mortgage could be added in. Again, as long as you're within the structure of the loan. But the seller's got to keep their guarantee on from the initial COI. So the difference between the first option where Josh talked about in this option is you're not changing the COI. You're not getting a replacement of coverage. You're just keeping the initial COI and guarantee in place. And all you're doing is just adding yourself on as a guarantor to the loan. This means that the lender just has to underwrite the deal internally because it's already been approved. Just make sure that you fit the requirements, that your borrower covenant is good, and you can typically close these within 30 days. You essentially are almost just doing a bridge into the assumption to be able to cover it, and then you can exit that out on a resubmission into CMHC, or maybe the term is coming up in a couple of months after closing and the maturity is going to be there anyways, and that's going to be an option for refinance. Whatever that exit strategy is, the main focus here is being able to close within an expedited timeline and not having to wait 3, 4, 5, 6 months like you typically do with CMHC. So if you have a deal coming up, tax season, end of the year, any sort of seller that wants to close quick, and you're telling them, 3, 4, 5 months, sit down, let's talk. We can figure out how to get it done. There are ways to be able to do it much quicker. We are going to have obviously a conversation with the seller just to make sure they're on board and they understand the whole process, because obviously telling them, hey, you got to keep your guarantee on place or on the deal for, a few months, probably going to raise some questions and some alerts. So there's going to have to be a conversation, but definitely there are options to be able to expedite the assumption to get in, close on the deal. You can still add the creative financing on the back end as long as it all works out and make everyone happy on the structure.
Yeah, oftentimes more than not, we do see that these multifamily deals are being sold with the assumable mortgage actually in place. And one of the advantages that you can use as a negotiating table is being able to actually assume it, because if a seller's trying to sell this property and they have to break the mortgage, usually it's interest to term, and it can be very expensive for a seller to be able to actually break these mortgages. So keep in mind that you can use it as a negotiating tool to possibly get maybe a cheaper purchase price initially, and then you can play that rate game or that renewal game. If your term is coming up for renewal, being able to assume their debt very quickly and then take them off as you come into the renewal stage might be a great way to be able to get a good price on a property while still getting phenomenal financing terms on the front end. So all things to keep in mind if you're navigating, looking to assume a mortgage on a multifamily property.
Now, something we got to keep in mind is down the road, obviously, depending on the equity position in the building and how much potential equity you're taking a look at, a refinance or a secondary mortgage down the road is probably going to be an option. So the biggest thing that we got to take a look at is just, where is the current interest rates? The whole point of an assumption is you're taking on an attractive rate, right? Something that's going to be much lower than where you're going to be able to get in today's market. Down the road, obviously, you have to understand that if you're looking to refinance that debt on the maturity, or if you're going to be adding a second mortgage, some sort of pari passu, second mortgage or CMHC, you have to take a look at the renewal rate, the renewal risk. So the refinances down the road, or again, adding on a second mortgage specifically, in the case of a second mortgage, they're going to be taking a look at qualifying that second mortgage at the current market rates of where mortgages are at for the seconds, along with the current market or current contract rate of that first position. But also they're going to underwrite a second scenario in the case that the renewal rate is a lot higher on the first. So if you're getting, for example, let's say a 5% interest on the second and the seller has a 1.5% interest on the first set of underwriting is going to be done with the 5 plus, the 1.5% and make sure that it meets the debt service. But they're also going to underwrite at the renewal risk, assuming that, in today's market, you're underwriting around roughly 4.5%. But let's just say it's going to be 5% to keep it nice and even with the second mortgage. You're going to have to be able to qualify for the first and the second at the rate of renewal risk, which could be that 5%. Sometimes, depending on how large the first position loan was and the interest rate, you may not be able to qualify for a huge increase, depending on the debt servicing, how much rental improvement has been done, how long since that mortgage got in there. So there are some things, depending on your goals with the mortgage further down the road, we're going to have to underwrite ahead of time and just ensure that, your financing strategies and goals are viable down the road too.
Yeah, if you guys got a lot from this video and you want to hear more about this, feel free to reach out to either Ehren or myself. We're happy to answer any questions you might have about assuming a pre-existing mortgage for a purchase. If you did like this video, please hit the subscribe button, hit the like button. It allows Ehren and I to do this more for you. We appreciate you guys, and we will see you next time.